the infinite banking concept is not for people that want short-term gains. It is not for people that are like, oh, hey, what if you cancel in the first 5 years? Or what if you cancel in the first 10 years? Then you shouldn't have had a policy to begin with. The goal is to never cancel. The goal is to pay premium until the day you die. Why would we not? The compounding happens. It's like saying, I'm going to buy this piece of ground and I'm going to put all the fertilizer and chemical and I'm going to get all the nutrients in the ground right to where I need it. And then as soon as it starts producing and I have these great yields, I'm going to sell it and I'm going to start over. Hello, and welcome back to the podcast. Thank you very much for being here. All right, John and I are back and we are going to continue the chapter reviews of Becoming Your Own Banker. So if you've not gotten the book, go get it. I don't know what you're waiting for unless you're new here. We are going into the chapter with how the infinite banking concept got started. This is a good one.
It is. I just was telling you it's the one I reference the most, probably.
And I find that interesting. I mean, I reference them all, but this is a good one. And it really, as I reviewed the chapter for this podcast, it's funny how a lot of that is playing out right now, especially in the agriculture sector, and how that's hurting when we have big operating notes.
Yep.
So the first thing that I would like to point out in this chapter is that Nelson talks about the fact that we are dealing with compound interest over a long period of time with no taxation of buildup. The reverse fact is that you must make an investment or you won't see any result for the same period of time. And he was a forester, so he studied forestry. You plant a tree and the tree grows. And I don't remember where he talks about this. We might get through it as we go further into the book. But he talks about the volume of interest versus the interest rate. And this chapter touches on that just a hair. But the fact that we're dealing with compound interest over a long period of time. I call it uninterrupted compound interest inside the policy. I wish that Nelson would have used that word. And maybe you've heard clients say this, but when we start talking about compound interest, they're like, oh yeah, my 401k does that. But does it?
Yeah.
Your 401k is supposed to compound, but it gets interrupted and then you have to start over. And so there's not really compound interest. I mean,
it's two different types.
Mm-hmm.
It's just like, you're paying simple interest versus earning compound interest.
Exactly. Yep. And so people think, oh, I'm going to put money into my 401k and I'm going to have compound interest, but it is interrupted. And then when he said the reverse fact is that you must make an investment or you won't see any result for that same period of time. It's like saying, hey, I'm going to win the lottery, but I'm never going to buy a ticket. Right?
Yeah,
you got to pay to play. If we are not going to use the policy and earn the uninterrupted compound interest, we're never going to know what we lost because that money stays liquid to use.
Yeah. I guess what I take away from that first paragraph is like, think long term. He was already trained to do that because of his job that he had, but you have to think long term.
But John, when people put money in a 401k and an IRA, they're thinking long term because they're thinking, I can't use that money till I'm 59 and a half and this is what I'm going to have, right?
True.
But we don't think long term when we have a life insurance policy because we say, hey, you get access to money right away. Even if we sold them, let's just say that we're just traditional whole life insurance agents and we're out here selling a traditional whole life policy with no paid up additions rider on it. It's going to grow slow. Those are good policies, right?
Yeah.
Nothing wrong with them. But you have to think long term because those policies are going to have money, but it's going to be long term. Why? This is what I'd like to know. If anybody out there listening can tell me, I'd love to know the answer. Why do you hold the life insurance policy to a different standard than your 401k? If I were to sell you a straight up base whole life policy, why do you expect money from that, but you don't expect money from your 401k until you're 59 and a half?
I think a lot of it's just because that's all they got an option for, like through their jobs. I mean, they just kind of take it because you have them.
I think it's because it's what we're told and we just accept what we're told. And we're like, okay, that's just how that works. But You don't hold the life insurance to the same standard. Now you're holding John and I to a different standard because we told you you can have access to some of it right away. But you were willing to put money in that 401k and that IRA and not have access to it at all.
Yeah, I would definitely say a lot of that's just because it's kind of somewhat forced through a job. And you think you're getting all that free money from the match or whatever, but it's not what it ends up being.
Right. Yep. It is long-term thinking. And this is not something, the infinite banking concept, I'm going to piggyback off of that, John, because the infinite banking concept is not for people that want short-term gains. It is not for people that are like, oh, hey, what if you cancel in the first 5 years? Or what if you cancel in the first 10 years? Then you shouldn't have had a policy to begin with. The goal is to never cancel. The goal is to pay premium until the day you die. Why would we not? The compounding happens. It's like saying, and I tell people this all the time, it's like saying, I'm going to buy this piece of ground and I'm going to put all the fertilizer and chemical and I'm going to get all the nutrients in the ground right to where I need it. And then as soon as it starts producing and I have these great yields, I'm going to sell it. And I'm going to start over.
Yep. You did all the hard work and then you're going to sell it to somebody else.
Right. Exactly. And you're going to sell it and who's going to win? The guy buying it.
Yeah.
Or you have a really nice cow, right? That she just throws like the best calves ever. And you're like, oh man, she's so good, but I'm going to sell her. Because, I got 4 or 5 calves out of her. So down the road she goes.
Yeah.
Really? What? You're not going to keep any of her calves back? You're not going to flush her? Like, what are you going to do? It's no different than these guys that have really nice bulls and then they're just selling semen straws. Like, you don't even get the bull. You just get the semen straws.
Yeah.
So if we've got it and it starts performing long term, why do we want to get rid of it? Doesn't make any sense to me. Towards the end of that first page, he says, and I use this a lot, and I'm assuming you do too, because you said that you use this chapter a lot, is that you either borrow money and pay interest or you use your own money and give up interest you could have earned.
Yeah, that's one of the bigger points from this chapter, for sure.
So you have lost opportunity cost. And a lot of people will say, well, I didn't give up. What do you say to those people that say, well, John, I paid cash for that combine and that combine makes me money. I didn't give up interest. That combine made me money.
Well, that's true, but every dollar has opportunity costs attached to it. So then you didn't earn interest on that either.
Right. So you could have made more money.
Yep. You gave up a little bit of extra there.
Mm-hmm. You gave up compounding and you gave up compound interest and dividends. And so you could have made more, but instead you were warm and fuzzy because you paid cash for a piece of equipment or you paid cash for cows and you don't want to have to pay that back because why would I pay interest on something? Because you're earning interest on the other side. So now we have lost opportunity cost.
Yeah. Uninterrupted compounding interest.
Right. Exactly. And the dividend. I also find it interesting right under that. He says, as long as things are going well and the financial gurus describe it, but they never tell you what happens when the lever goes the other way. Yeah.
I just think his whole story here is kind of interesting to up top on the next little paragraph there. He says, I could do no wrong. I mean, he thought he was hammering it out of the park, like couldn't miss. And that can go really fast the other direction too.
Mm-hmm. Yep. And that is the reason that you and I are so conservative. When people come in and say, hey, I want to do $300,000 of premium, or I want to do $100,000 of premium, or I want to put all of my operating, I want to borrow from operating and put it all in the policy. We're like, oh, kick the brakes.
Pull back.
Right? Because we might see you when commodity prices are high or cattle prices are high. We are waiting for the lever to go the other way. And when the lever goes the other way, you still have a premium to pay. You still have loans you should be paying back. Yeah. And other agents in this industry are doing what Nelson did right here. They're leveraging, and Nelson says that in the paragraph above, magic of leverage. They are leveraging everything. They're taking a HELOC against their home. They're borrowing against their land to put it into life insurance policies. Because why would I not leverage it? Why would I not go to the bank and borrow money and use my life insurance policy to be so leveraged that if the lever turns the other way, oh, I'll be okay. No, you're not. No, you are not.
It all works just fine when everything is going good, but
Mhm.
that day is going to come where it goes the other way.
And this story is important because of the fact that Nelson got caught with his pants down. And guess what? People in this industry forget about the story. They forget about the Nelson was leveraging and he could do no wrong. And then wrong hit.
Yep. A lot of it, actually, by what he describes. So
Yeah.
that had been a pretty rough year for him. I guess he did get to go on a nice European vacation. That was probably the highlight.
He did, and he never saw his land. He was on he never saw the land he bought, but he went to Europe. And then he said, this is also interesting. Banks are not lending you money because you have real estate. They are doing it because they think that you can make a payment. So think about this. This got pointed out to me by another agent that banks don't want whatever it is they have as collateral. They don't want the combine. They don't want the land. They don't want the cattle. They don't want your thing as collateral. They want the payment because that's cash flow so that they can what? Go to the Federal Reserve and get more money.
Yeah.
And so we have to remember that banks want payments because of cash flow. We should be wanting the same thing as well.
For ourselves.
Mm-hmm. Yep. He also said, I got accustomed to paying 9.5%. Accustomed.
That's crazy. I mean, I can't imagine that being your normal, I guess. It is currently, but it feels abnormal to us due to the low interest we were paying.
Because you were accustomed to 3%, 2%, right? So just as he was accustomed to 9, we were accustomed to 2 and 3, especially, I'm going to pick on you, especially your generation.
Oh, yeah.
Who never had the high interest rates before. Now you're all mad at us Gen Xers and boomers saying, hey, you guys, this was what it was like.
Yeah, I thought they had it locked at 5 max or something.
So he got accustomed to 9.5, and then it went to 21, and he was at 23 with $500,000 of debt. But he wasn't. A lot
of interest.
It was what?
$67,000.
$67,000, and it was not $500,000 of debt. What Nelson does not tell us in this story that he tells us in seminars is that his business partner filed bankruptcy and Nelson inherited another $300,000 on top of this $500,000.
Oh, really? I did not know that.
Mm-hmm. So he had $800,000 of debt at 23%. So if we take $500,000 of Nelson's money in 1981, put it into the inflation calculator, in 2024, this is 2025, obviously, as we're recording this, but that would be equivalent to $1.7 million in today's dollars.
Please. And how about his interest payment then?
His interest would be equivalent to $233,000 of today's money. Every single year, that's what would have to be paid. But that's only $500,000. That is not the $800,000. So he was not expecting to pay that. What do you do? What do you do when you are in a situation where all of a sudden I can't make these payments? There's only 2 options.
Well, he stayed up all night praying, so that's what he did.
He did stay up all night praying, but the other thing he said is, you find a fool that will buy it under these circumstances. But is the guy that's buying it really a fool, or is he coming in and getting it at some bottom barrel price because he had money and so he could do that? But what Nelson did was he stood up all night praying. And here's the part about the praying that I think is interesting, is he said, Lord, please show me a way out of this financial nightmare that I have created for myself. I tell you guys all the time, your brain is not going to find a solution to the problem if you're thinking negative, right? And the question you need to ask is, how can I? And Nelson said, Lord, how can I solve this myself? So he was asking for a solution. He did not What Nelson did not do was crawl underneath the covers and say, I can't do this.
Have a pity party.
Right. So we have the option to say, hey, we're in this situation. Because I think somewhere in here, he talks about the fact that they would, every 90 days, they would readjust his interest.
Yeah.
Well, what's happening right now in the agriculture sector is very similar, right? We've got 5-year balloons or we got every 5 years, we're maybe going to have to recalculate or refinance the loan we had on a 20 or 25-year mortgage. I do know all of you listening, thank you for telling me there are locked in rates on land. Nobody's ever tried to sell me one of those. But I actually talked to someone the other day that he had a locked in rate at 4 or 5, and he refinanced it to a variable rate because rates were so low. He thought that they were going to stay low.
Oh, wow. That's something.
It is it right or wrong? I don't think so, but it is a matter of saying, I probably should pay attention to history, and I probably should think about what's happening with inflation and how does the economy work? Because for myself, I'm like, I knew a variable rate was not going to be a good option. They never told me I could get a locked in rate or I'd have did it because I knew rates were going to go up. When you're paying attention to how the dollar works in the economy, you understand rates have to go up in order to stop inflation. And we were in such an inflationary period that there's no way they could stay at 2 and 3% or 0.
In that guy's situation, he's kind of like Nelson at the beginning of the chapter where he just kind of thought there was never going to be a change from the good times.
Mm-hmm.
You'd think the train is just going to keep on rolling.
Yeah, that good point. And so he also says in there, he was standing in the midst of everything that looked bad or whatever, and he didn't see that he had money in life insurance that he could get at 5 to 8% out of 3 different policies.
Yep. The only thing that limits how much you can get is the same thing they tell you at the bank. How big of a check can you write? How much have you put in?
So there's a couple of things there. One, he was borrowing in the 80s when interest rates were 23%. He was borrowing from 5 to 8. If that is an indication of how life insurance companies work, then if interest rates even go higher, we shouldn't see rates higher than 8%.
That is what I reference back to all the time, is that just because the Fed's going crazy, that doesn't have anything to do with what the life insurance company looks at.
Right. Because they go based off of a Moody's bond average. But even bonds were back then, bonds were 15 to 18%. So you would think that they would go higher than 8. When I took my license, and I don't know, maybe you remember this from your license, I swear to God, somewhere I read that insurance companies cannot charge more than 8% on a policy loan.
I don't remember ever seeing that anywhere, but that could be true.
Nobody does. This is I don't know if I dreamt it. I don't know. I swear to God, I saw it. I can't find it again. I've called the insurance department. I cannot find it. I could have swore it was even on my test. It was a test question. But if it's 8%, that kind of correlates with Nelson's 8%.
Yeah.
That was the max that they could use. So that's one point from what we just talked about. But I think another point that I really like is the only thing that limits how much you can get out is how much you put in.
Yep.
We just talked about that in our last chapter review.
Yep. Put peanuts in, you get peanuts out.
Exactly. So how much do you want to get out? And he said, had he not been accustomed to paying very large premiums, he's doubtful he would have seen the message. Hardship often helps you to see the things which we are normally blind to. And we see that a lot. Some of our clients, I would probably say the majority of our clients have at some point been super frustrated with the bank and the loss of control. And so this is what attracted them to infinite banking and the fact that they want to take that control back into their operation.
Correct.
He was also accustomed to paying that. And we're going to get into Parkinson's law later. But Nelson always talks about the fact that if you're done making a payment on something, that payment should go into a new policy. If we have a $100,000 combine payment or a $100,000 cattle payment, we're accustomed to making that payment. What are you going to do when that payment ends? Why are you not using that money to create your own banking system? Instead, we go buy something with it.
Yep.
Or we create another payment because, oh, that one's done. Now we can go buy something else and just create another payment. If we do borrow against the policy and to pay off a debt, we were accustomed to paying the payment to the bank. Why not use that same amount to pay back your own loan?
Do you know how, like, did you ever get to ask Nelson how old those policies were that he borrowed from?
He talks about it in some of his webinars. His first policy, if I remember correctly, he was 16 when he bought that policy, which I also find interesting because today we can't own a
Yeah, you'd
policy
not
under
be able to do
18.
that.
Yeah. But was he 14 or 16? His dad actually told him that he needed to. And then I don't know at what point, because he was a forester.
In my mind, I have like the 50s in my head.
So Nelson had a heart attack at 52. And that is when he understood that he could put the paid up additions rider on. Well, he understood it before then. He understood it now because this is how he got money through the policy very quickly.
Yeah.
But he didn't start teaching it till he was 52. He didn't start teaching infinite banking till he was 52. But if he was a forester in 1952, he went to school. He was done with forestry consulting in 1962. So, and then he sold life insurance for 30 years.
Also then probably
So he must have been selling life insurance either during that time. I don't know. That's a good question for David.
Yeah.
But those policies were, because he could not buy a policy after 52 on himself. So those policies, he obviously had 3 of them by 1980. So he had, they obviously were old.
At some point when I read this, I wrote down time, money, discipline. Because he already had the time into these policies where they had a lot of cash value, which had the discipline to put all that money in there each year. I'm sure there were times where he didn't want to pay the premium, but he did that. And then that's what ended up solving his problem.
Yep.
So,
yep. He said, though, how could I do both? How could I get more money into the policy? And that is when he came up with, I could revise my spending pattern. And that's where Parkinson's law comes in that we'll talk about later.
And that's really something we do when we meet with somebody is we just look at what they're already doing and how we can change maybe a couple little things to be able to do this process.
Mm-hmm. Yep. We're just using money you already have. We're not asking you. You're right. When we meet with people, we don't necessarily say, hey, where are you going to come up with this extra money? Go get another job. And you don't have to do what Dave Ramsey says and
quit going out for supper.
Yeah. Now, sometimes, John, we do have to say, where is all that money going?
Yeah. Yeah.
So you may have to quit drinking some beer because you're spending a little too much. Like I like our really young clients that are in their 20s, early 20s. And I'm like, how much are you spending at the bar every week?
$100.
Yeah, I'm like, that's a really nice policy. And I do think it's funny that he says that everyone thought he was funny because it was opposite of what all the experts said. But he was objective, looking at the facts of how life insurance worked, plus reason and logic. And he had continued sessions with intense prayer.
Yeah, it'd have been interesting to talk to him about like how many different people he talked to during this whole process of like, because I'm sure there was a while where he was like, all right, will this really work? To get this gone? Like, who did he talk to and what was their feedback exactly? Like, were they like, you're insane, this will not work?
Well, you do know, and I don't know if you've heard it. He doesn't talk about it in this chapter, but he always talked about it in real life that it took him 13 years to get rid of the snakes and dragons.
Oh, wow.
So he had $500,000, which was what, 1.7, I think I said.
Yeah.
He had all that debt that he got rid of in 13 years. And he got rid of the snakes and dragons in 13 years. He moved it over to debt in his life insurance policy, but he was no longer subject to the banks. In 13 years, $1.7 million. We can't have people pay off a mortgage in 13 years at 3%.
No. That's like when somebody wants to, replace their line of credit overnight. Sometimes that doesn't happen in a year or two. That might take you 7 to 10 years or more. It depends
Great
on what you're
point.
wanting to put into it.
That is a great point. It took him 13 years to get there. It might need to take you 13 to get your operating moved over. And he says, maybe you have found yourself in such a financial position, or maybe you want to develop a system that will help you out. It requires understanding and it requires discipline to implement the idea, but it can change your life dramatically, even beyond your fondest dreams. And I think that a lot of people think that this is just easy. Oh, this is just easy. I'll buy a life insurance policy and I'll never have to look at it again. Nope, it actually requires discipline and understanding. So you need to understand why you have the policy. You can't just buy a policy from us and then never talk to us again. I mean, I suppose you could, but you should be tuning into these podcasts. You should be attending Coffee with MJ so that you have this continual learning. And it requires discipline, meaning you need to pay premium and you need to pay loans back.
Yep, you have to be a good banker.
Okay. Any other additions to this chapter that you use with clients or things that...
I just tell the story and then refer to the interest rate thing and just why we're different than what a bank is.
Okay. All right, guys. That was how the infinite banking concept got started. If you have, the routine, comments, questions, concerns, let me know. If you need to grab the book, go to farmingwithoutthebank.com, grab the book. If you need to make an appointment, you can make an appointment with myself or with John, and we are happy to help. That's what we're here for. Those are the next steps. All right. Have a good rest of your day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.